We will analyze the financial statistics of Stanley Black & Decker using business ratios that are based off the data from 2017, 2018, and 2019, compared to the industry average. This analysis is done in July of 2020, with the current threat of COVID-19 affecting the United States economy severely. We will analyze the effect of this global pandemic on this company and predict whether we feel like the company will be able to survive this depression, and whether or not the company is a good investment for current investments and employment. Stanley Black & Decker, founded in 1843 in New Britain, Connecticut, is a company that has had its hands in many pots, from power tools to lawn care products for sale at home improvement stores such as Home Depot to professional home improvement companies. This company also has an industrial sector that contributes products for automotive manufacturing, electronics, construction, aerospace, and more, while also having a hand in the oil and gas industry through pipeline construction equipment and evaluation, as well as other vital tools to the industry such as hydraulic tools, attachments, and other accessories. The company also has a security section through development, manufacturing, and installation of security services for both private and commercial residents. With the company being contributors to many parts of the economy, we will evaluate their financial record in recent years and observe the effect a nationwide recession has on the company. Over the past 3 years, the company's stock prices have steadily rose, peaking in the beginning of 2018, followed by a decrease in stock prices until 2019, where the price begins to climb again and eventually plateau right around the 2019 holidays. This is followed with a sharp decrease due to the recession and has currently risen back to normal levels. As the figure shows, displaying stock prices for the company from July 2019 to July 2020, stock prices plateaued around the 2019 holidays with a slight increase right before the recession began to hit in March. The company's stock has then made a steady recovery as stay-at-home orders were revoked in phases outlined by the governors of each state. As previously discussed, SWK's customer base is composed of many different departments, such as Department in Discount Retail, Home Improvement, Professional Services, Electric Utilities, Oil and Gas Services, Machinery and Components, Construction Services, Mining Industry, Aerospace, and Security. The 2019 coronavirus has made every company in this industry suffer. Specifically for SWK, the company saw decreases in customers in many sections, such as the Department in Discount Retail Industry, Oil Well Services and Equipment Industry, Industrial Machinery and Component, Construction and Mining Machinery, Aerospace and Defense. However, there are some sections of the company that have seen positive changes in the number of customers due to the pandemic, including home improvement, electric utilities, and construction services. In this figure, we can see the 2017, 2018, and 2019 business ratios compared to the average industry ratio. Each of these ratios gives us a very important insight to the company and are defined as: return on assets is the measure the ability for a company to transfer assets into an operating profits. Return on owner equity measures how effectively management is using a company's assets to create profit. Current ratio analyzes a company's working capital conditions. Acid test ratio, or quick ratio, measures a company's ability to cover short-term debts using readily convertible assets in an emergency situation. Accounts receivable turnover quantifies a company's effectiveness in collecting money owed by clients. Inventory turnover ratio, numbers of times the average inventory value passes through the operational of the company. Debts to equity ratio measures all of the overall financial strength of the company. Times interest earned ratio measures a company's ability to pay off debt based on its current income. And operating income to total assets is the indicator of how effectively the company uses its assets to generate earnings. We can see that there are many ratios for this company that fall above the industry average, such as return on owner equity, acid test ratio, account receivable turnover, inventory turnover ratio, debt to equity ratio, and operating income to total assets. While there are some ratios that fall below the industrial average, such as return on assets, current ratio, and times interest earned ratio. Overall, these business ratios indicate a strong, independent company in recent years. When observing these ratios, we feel that one of the most important ratios currently is the acid test ratio. This ratio exemplifies the company's ability to be prepared for unforeseen recessions and other setbacks, and accounts for the company's ability to cover short-term debts using readily convertible assets. Since we are analyzing whether or not this company would be a good investment, this ratio is extremely important because it showcases and provides prediction on whether or not the company will be able to survive the current recession. With the acid test ratio of Stanley Black & Decker being above the industry average, this shows that the company has a good fighting chance to pull themselves out of the depression, which is also reflected by the rise of company stock prices as mentioned before once stay-at-home orders were revoked. Next, we will evaluate the times interest earned ratio. This number falls below industrial averages for our company, indicating that while a company can survive the initial drop of the economy, proven by the acid test ratio, if the company was to go on for months with little income, the company would then start to struggle in its ability to pay off its debts. Luckily enough for Stanley Black & Decker, the statewide shutdowns began to lift after only a few months, and the company can begin making considerable profits again. However, it is also important to note that had the lockdowns continued longer, or should they resume, the company would be in greater trouble than they were during the first round of shutdowns. In the end, Stanley Black & Decker Company participates in many different aspects of the economy, which helped them in the initial economic drop due to the worldwide pandemic. When customers' numbers from certain sections of the company dropped, others rose. And looking at the stock prices from the last 3 years to the sudden drop and current recovery of the company stock, we can see that this company has the ability to recover from a strain of the economy so far. We also looked at the company's business ratios and observed where the company generally fell above or below the industry average. And using these ratios, we concluded that the company was strong enough to survive the March stock dip. However, we can also predict that had the lockdown gone on longer, the company would have struggled more. Based on the company's business ratios and stock market prices over the course of this year, we believe that this company would be a good current investment and employment option. However, we must continue to be wary in case shutdown protocols resume again. The company should be planning on how to manage a restricted market for the rest of the year to plan ahead for other possible COVID economic interferences. Investors, however, should not have too much to worry about. The company's diversified income should help the company survive, and while stock prices may drop again, we do believe that they will be able to rise once more.